As you know, valuation is that one number that finally an investor and an entrepreneur agree on. But there are a whole bunch of things that drive that number. And so, what are those? Of course, the intrinsic value of business itself is one driver. But who decides what is the intrinsic value, right? Who decides what that value is, right? And that is where a whole bunch of issues come up, and we'll go through some of those. There's something called exit multiple. How much money is the investor going to make when they exit the investment, which means they sell the equity that they hold in that business for a profit. So what is likely valuation at that time, and therefore what percentage of stake they should hold in the company so that they will make the returns or get the returns that they expect from that, right? There's also market price of risk. It's something like, if you want to buy anything, if you want to buy a new flat in Pune, or you want to buy Reliance shares, or you want to buy a kilo of apples, you are not likely to pay a price that is substantially higher than what the market is paying for that. And same thing is true with this as well. So in early stage investing, what are other VCs paying for similar kind of risk? That is also a driver in this. We have strategic interests and we have emotions as two other drivers. If you look at these, the top three have numbers associated with them. Some number is driven from this. The bottom two are more qualitative drivers. By no means unimportant, or probably more important compared to all the ones that you see on top, right? So we're going to go through some of these to understand how valuation happens and what all goes on. Typically, right? There's no formula or there's no recipe that tells you what will be that value of that business that pretty much everybody will agree on, because a theory or some empirical model tells you so, right? Ain't gonna happen. Before that, what are we all up against? And I'm going to talk in terms of, or in the context of venture capital valuation of very early stage businesses, right? I'm going to give you some numbers, statistics. 14, these are the percent of first-time entrepreneurs who actually succeed, right? And this is across the globe. And that's a pretty small number. Vishwas asked, I think, how many are first-time entrepreneurs. So a whole bunch of people raise their hands. If you just look around yourself, 6 of your neighbors need to fail so that you can succeed. I mean, literally. That's not how statistics work. Statistics doesn't discriminate. Something else discriminates as to who succeeds and who doesn't. But that's what that number is. However, if you have failed the first time, right, and start a new business again, so second-time entrepreneur, about 18% of them succeed. Right? So there is some learning that accrues to you, which helps you succeed the second time. But that gap, that increment is not that big. Right? However, if you have succeeded the first time and start a business again, and there are plenty of examples here, then it is a 27% chance that you will succeed. Right? So, first time success, second time success. Okay? If you put these numbers in perspective, it's very clear as to who VCs will prefer to invest in. Right? So, but we as well as VCs, we means, I count both. I'm kind of schizophrenic, by the way. I'm a VC. I have my own business as well, so I'm one of you as far as entrepreneurial things are concerned, but also VC. And sometimes when I say we, I don't I kind of forget myself as to which part of my brain I'm talking about. But we as entrepreneurs, right, have this problem because VCs would prefer experience. At the same time, they don't have that many experienced people to invest in. So they have to come to us. And so we need to decide, and we need to understand what it is that we are going to do in order to get A, first become investable, and B, get a better valuation. Right? 33% more second-time or repeat entrepreneurs get funded by VCs compared to first-time entrepreneurs. So that also talks to that. And 90 is the percentage number of startups that substantially change their strategy, have to change their strategy in the very first year itself. And both Vishwas and Kiran talked about it as to, your business plan falls apart when you meet your first customer and all of that. All that is true and backed by thousands and thousands of examples of startups, right? I'll explain why I showed these statistics compared to others, because everything that I said here in terms of these statistics has a bearing on the ultimate valuation, right? Before we proceed, I just want to explain how venture capital works, because many people don't understand that, judging by the kind of proposals we get saying, I'll return your money in 5 years and 15% interest or something. And then we say, we don't do that. We are not a bank or a lending institution, but that's very common, right? So a bunch of people who think very highly of themselves, and very rarely, deservedly so, come together. They are called GPs, general partners. They are the venture capitalists, right? They go to a bunch of people who are insanely rich or represent companies or entities that have a lot of money and want to put some of that to work to invest in startups. These are called LPs or limited partners, right? They raise money from limited partners. Limited partners give the money to GP to invest on their behalf. Their expectation is typically 20+% return per year, right? The GPs in turn take that money and invest that in startups, and their expectation is way above 20% per year return. Why? We'll come to that. The way the money is invested, about 1 to 2 years, GPs spend raising money, about 2 to 3 years, they actually deploy that money, means invest in startups for equity. And the next 3-4 years is when they actually try to sell that equity at a profit, very similar to how you invest in mutual funds or whatever, in order to make money, right? To do that, the GPs get about 2 to 3% of the total fund size as the management fee, similar to the management fee or expenses that your mutual fund managers get. And then about 6 to 8%, if there is any profit, right? The first 6 to 8% goes to the investors who put in the money. If there is anything left after that, then it is shared 80-20. So 80% goes to the LPs, 20% go to the VCs. And that is where VCs make big money whenever they do make big money. So the question is, why this 20% return? Why is it that high? And the answer is very simple. You look at this statistic, this is the post-tax returns of some of the asset classes that we know, equity and realty and gold and so on and so forth. Focus on this 10-year thing, and equities, that is the broader market, the Reliances and so on and so forth, returned almost 17% in India, right? In a 10-year period. This is post-tax. Now, would you agree that investing in a broad market basket of stocks is less risky compared to investing in a startup which doesn't even know what its business plan is, or is going to have to change that business plan within 6 months when they start to talk to that first customer? And I hope everybody says yes.
Yes.
Because if you think no, then want to raise money from you. So if that is 17%, then you have to look for and you have to expect higher returns, right? Because that startup investment is risky. Why do VCs ask for much higher return compared to 20%? If 20% is what their investors look for, why is this much higher? And it's simply because we all as entrepreneurs look only at the opportunities. The flip side of that coin is the risk. That is what VCs are looking at. And that is something that is extremely important to understand because as first-time entrepreneurs, how you can try to start bridging that gap between the second-timers and first-timers is by understanding, some of these risks and plans to address those risks and so on and so forth. So it is important that this is what VCs are most worried about. And how does it play its part? We already saw it in the statistic before. Only 14% of first-timers succeed. And even second-timers who were successful the first timer, only about 1/3, less than that. That's a pretty hairy statistic. When we invest, the VC part, we assume that about 1/3 of the startups are going to fail outright, right? All the money will be lost. About 1/3 are the ones which will just return barely our principal and maybe a little bit more. And 1/3 are those that are going to give us the profits, out of which we will pay 20% 20% return to our LPs. If we don't do that, bye-bye next fund, right? Nobody is gonna give us money to invest again. And it's a very simple math now. You have probably heard that VCs ask for 10x return. They're greedy. No, that is just the way the maths work. If you look at this 1/3, 1/3, 1/3. So assume there is 100 rupees that I have, invest in a 5-year fund, which means I need to return the money in 5 years to my investors, right? If I want to meet their expectation of 20% year-over-year returns, then I need to be left with 350 rupees. That's the way the math works at the end of 5 years, so that I can return the principal, 100 rupees plus the profit. Okay? Out of that 100 rupees, I have to keep 10 rupees aside because my management fee is 2%. Right? So for 5 years, I need to pay my own salary and the travel and the wining and dining and all of that. Right? So I invest 10 rupees each in 9 startups, let's say. 3 fail completely, so my 30 rupees is gone. The other 3 just barely return my money. So at the end of 5 years, I have 30 rupees from 6 startups. I invested 60 in them. Which means the remaining 3 are the ones who are supposed to give me 320 rupees back so that I can return 350 to my investors. If I asked you to be in the shoes of that VC, investing in the first 2-3 years in these 9 startups, knowing that it is going to take 5-6 years for you to be able to sell the startup or your stake in it, would you know which 3 belong to the third category? No. Obviously not. And therefore, every startup that you invest in, you have to invest with this lens. Does this startup, does this team, does the market, does the opportunity, does the business model, all of it, does it show the potential to give me that 10x return? So 320, 30 rupees I invested in them, 290 is what they need to give me back. For investing 30 rupees comes to about 10x in 5 years, and that is how that 10x comes. Right? Very simple math. It is not because it is greedy or whatever. It is because the statistics just works that way. Right? Of course, people are greedy. I'm not saying they are not. I'm just saying that even if they were not, this is what you would need to give because people expect, and that's why they list all that money, right, on the startups. The return translates to about 60% per year. That is the price of risk that they are taking. Okay? Just basic financial math so that we can understand how valuation is attempted at but never used, okay, which is the DCF. Nobody in their right mind actually does discounted cash flow for these early stage companies, right? As both Vishwas, Kiran talked about, if it is an established company launching an established or a new product, a lot of history behind it, balance sheets and profit and loss accounts and so on and so forth, then you can do something like this. For a company that is yet to make their first dime, this is impossible. I mean, it is all possible, but it doesn't make sense. Still, this is very common, and it has certain usage, right? And so we will go through that. A very simple concept, future value of money. If you invested 100 rupees for 1 year at 10% interest rate, you're supposed to get 1 year later about exactly 110 rupees. You invest those 110 rupees again. At the end of second year, you're supposed to get 121 rupees, and so on and so forth, right? So the formula is in the nth year, after the nth year, you're supposed to get 100 multiplied by 1 plus 0.1, bracket raised to n. I'm going to move very fast. I hope people are not so math challenged that they won't follow. But as he said, I'll share some of these formulas, which are actually very simple. Right? So the future value of, let's say, P0 invested in 0th year today, right, after nth year, at R% return per year, is given by this formula. P0 multiplied by 1 plus more R. R in this case is a fraction. It's not the 10%, it is 0.1. Right? Remember. Now if future value is this, can you just turn it around, which for some reason is extremely difficult for people to do. Right? Everybody understands and gets this future value kind of stuff a lot faster compared to the present value of that future thing. So what if I promised you P sub n, rupees, n years from now? What is the value today? Right? That is the kind of question we are asking when we talk about present value. And it's a very simple math. You just basic algebra and you get the present value, P0, right? It's very simple. Everybody follows me?
Yes.
You're not as challenged as I thought. So present value, in a general sense, is given by this formula. What is the net present value? This is what we want to come to because this is something that you have probably heard as far as a business is concerned. That is simply the present value calculated of all the future cash inflows minus the present value of all the current and future cash outflows. It's very simple, right? What are the outflows? You need to make investments today for capex, whatever, and then you need to keep making investments, not just by raising capital from outside, but even from your own business, from your internal accruals. Those will be the cash outflows, and all your profits and so on and so forth will be your cash inflows. You just subtract one from the other, and you get the present value. Before we move on, I'll also tell you what IRR is, because you probably will hear this term, and it's called internal rate of return. It's simply that R that we used in the formula, right? Which gives an NPV of 0, right? How is it used actually? If an investor knows what is his or her desired rate of return is, then he or she will look at an investment, and if they feel that NPV is 0 at a certain R, which is higher than what is their desired rate of return, then they say, this is a good investment. That is how IRR is used. Again, this is just so you feel that you understand, some of the basics of valuation, if you run into it. But as I am going to tell you, this is not how it is done. Okay, so we just wasted 5 minutes of your time. Using discounted cash flow, just P1, P2, Pn, these are the cash that you are going to get in year 1, 2, 3, 5, 4 up to n, and then you just get present values, and that is your discount cash flow model. Okay, It's very simple to actually do. What is difficult is understand what are P1, P2, and Pn going 5 years, 7 years, 10 years, right, into the future. So, there is a concept called free cash flow. What is that P1? Right? P1 or P2 or whatever is free cash flow. What it means is whatever your profit is, which is your revenues, subtract all your expenses, right? Pay your taxes, and then reserve some money because you need to reinvest into the business for the next capital or whatever. Whatever is remaining that you think can be actually distributed as dividend to your shareholders. You don't, but you think you can. That is your free cash flow, right? And that is what this is. I'm going to take an example of a fictitious company, which is IT-enabled fintech company, and purposely making it a little bit more complicated than just an IT company. And you'll also see why, and I have a wild example here. One is the free cash flow that the company will earn or get in the first year. If you bring the present value of that, then you get 0.62. And then I have done it for 5 years. In the 5th year, the company has done really well, has 50 crores as free cash flow, and you have all these present values for every year's free cash flow expressed today, right, at this time. If you sum it all up, then you are going to get 12 crores as the valuation. Is that good? A company that is going to generate 50 crores of free cash flow in 5th years, if you were to build that company, are you going to be happy if I said, your valuation is only 12 crores today, right? Likely not. But wait, this is not the whole story. The reason is that your company is not going to just die at the end of 5th year. So it is going to continue. So something called terminal value is used, which says at the end of that 5th year, if I look to the 6th, 7th, 9th, 10th year, how will this company be valued at that time? And there is a simple formula that gives us that. R is again the rate at which we calculate all this, and G is the growth rate of the company, right? All assumptions, by the way, right? And this 50 crore at that time will give us a valuation at that time, 5 years from now, of almost 91 crores. But it is 5 years from now. You need to bring it back to today, right? And therefore, that 90.91 brought back to today gives 8.67. Add the two, and it gives you a better present value of that company. Not something that is going to thrill the entrepreneur who's building this.
Right? Anil, just a small question. Why are you discounting the cash flow at the rate of 60%?
We just went through that because I don't know whether this company is going to fall in the 1/3 that just died, or 1/3 that barely returned the money, or 1/3 that gave me my returns. And so I'm going to look at every company with that thing. And then, if I need to therefore, evaluate from a 10x return point of view, that means just math. It turns to 60% off. That's what I'm using. Okay? Just do the math. That's it. Why does it suck? It's really hard to get that R, especially get two people to agree on that R, right? I'll say 60%, and you'll say, are you out of your mind? I'm building such a great product, a great team, great market, this, that, etc., etc. The risk is not that high. It should be less than 60%. So even in my mind, I don't know many times what R to use, and therefore I don't use any. And then the cash flows are highly speculative, as all of us hopefully can agree on. We have all this optimism, etc., but they are speculative. Does it mean these 5-year forecasts are completely useless? No, they are not, and we'll talk about that a little bit later. How exactly the valuation is done by VCs, and that's what I'm going to tell you. Before that, just some jargon, two things that you will hear: pre-money valuation and post-money valuation. Pre-money valuation is simply the value of the company before the investor puts their money in the bank account of the company. And post-money valuation is the valuation of the company the instant after that money hits the bank account of the company. It's very simple. Why? Because if your company was valued at 5 million or whatever, and then I invested 1 million and put that 1 million cash into your bank account, right after that, your company value is 5 million that it had before, plus 1 million that is in the bank, and therefore 6 million. It's a very simple concept to understand, but people still sometimes get confused as to this whole pre-money, post-money. The real question that VCs ask in their mind is not about value of the company. It's about the percentage stake that they need to hold in order to have a sliver of a hope to actually make money on this particular investment, right? So if you get a low valuation, that is not necessarily a reflection on you and your ability as an entrepreneur or your idea. That is because of all the reasons that we said before. And what they are doing is essentially saying, I want this much stake in this company. And how do they come up with that? Again, a little bit better than DCF, I would say, but not much more so. Simply they say, for example, if the investment that is being raised is 10 crore, and let's take an example that the net profit 5th year from now is 50 crore, the VC wants to sell the company or its stake at that time. So it says, if this company was getting a net profit of 50 crore 5 years from now, what would be the valuation at that time? They don't know, so they use the PE ratios, etc., that they find in the market today of established companies whose PE ratios are available. Make a guess, okay? In this case, let's say the average is 20, and they say, therefore, the projected valuation of this company could be 1,000 crore 5 years from now. Of course, this is based on today's and public company numbers. Typically, the trade VCs would give a discount of 25% to that and say, if public company data says 1,000 crore for a private company like that, I'm going to assume more like 750 crores, right? And then that 750 crores, if I want to get 110 crore back 5 years from now, 10 crore investment today, which gives me my 10x return, right? How much percent stake do I need to hold at 5 years from now so that out of those 750 crores, that 110 will be mine? And that's a very simple calculation that tells us that about 15%. Okay? So the VC says, I need to hold 15%. This is a very simplistic assumption because there may be other funding rounds in those 5 years which will change the holding level, but it's just a little bit more complex math, nothing else, right? And a whole bunch of other sets of assumptions as to valuation during those rounds. But let's keep it simple. Say, I invest 10 crores, the company is not going to need any more money 5 years down the road. I'm going to be able to sell my stake, right? So that means I need to hold even today 15%. And if I need to hold 15% for investing 10 crores, then what is the valuation of the company? If you just do the math, the post-money valuation of the company will come to about 68.17 crore. That includes 10 crore that I just invested. Therefore, the pre-money is 58.17 crores. Okay? The two numbers are quite different, right, based on what we saw. So, different ways of valuing will give you, radically different numbers, right? But this is typically how valuation happens. Is this kind of foolproof? No. Who knows whether 50 crore is actually going to happen? Who knows 20 is the right multiple at that time? Who knows? Right? So this is a whole bunch of gut calls. And that is just the nature of the business. That's why after doing all this, you still have only 14% and 18% kind of success rates. Okay? Use a 5-year projection, just knowing if there is this big opportunity. Do you see it? Do you see some way or hope to really tap this big opportunity? Why this big opportunity, by the way? Why this infatuation with really big markets? Is it $1 billion opportunity? What's wrong with 100 crore or just 100 million opportunity? It's very simple. Early stage investor sells their stake to a bigger fish a later stage investor, that investor is not going to be interested in the company if he doesn't see a much bigger opportunity, because he has to sell it to a yet bigger investor. Finally, the public, which is the biggest investor, right? Which means going IPO. And then exit these multiples as we talked about, and finally hold you accountable to that. When the investment actually happens, it will happen with reference to your 5-year projections. And so just to get bigger valuation, if you do something with those numbers, it may come back and bite you. So be careful with what you project. There is this market price of risk, as I said. What are other VCs doing? How much money are they paying, and how much % stake they're taking for similar risks? And when I started in this business about 10 years ago or so, this number that was being bandied was about 33% for $2 million valuation, right? Is it the same today? No, it is not the same. Look at Flipkart, look at many other e-commerce companies. This is not the market price. Depending upon the kind of company, the sectors, etc., it is different. The point is that VCs do look at whether I'm paying enough or whether I'm paying much more for this kind of opportunity. What are others doing? How much have they paid? So on and so forth. It's not public knowledge, by the way. It's through network, etc., I'm guessing, and so on and so forth, that you try to gauge that. That brings us to the other. So far these 3 things: the DCF, the exit multiple, this, what is market price of risk. These are numbers things, right? Based on numbers, deliver a number. The ones that I'm going to talk about are not numbers. They finally influence the number that I came up with, okay? But they by themselves do not have any kind of formulae or method to generate the numbers. And now all of you are going to play VC with all the knowledge that you have about how venture capital works, which is not much, because there's not much knowledge anyways with the VC. If they had, the success rate would have been much higher, right? It is not. So you are as informed as VCs are now, okay? So fund stage, we talked about it. Your fund is in the first year of deployment window. Anybody? The question I'll ask, the situation I'll explain, and you need to decide whether I would be inclined to give a better valuation than what the numbers suggest, or a lower valuation than what the numbers I came up with, right? If it is in the first stage of deployment, we talked about 3-year deployment window, right? Anybody wants to venture a guess? No? That's clueless as you were before. This is not about venture capital. This is just about human behaviors and incentives, right? So if I'm in the first year of my deployment window, and this is one of the first few that I'm looking at, it is quite likely of 2 things. And again, this is very schizophrenic. It can go either this way or that way. Is this something that I want to essentially invest in fast, so that I can actually start telling my LPs that we have started making investment? In that case, maybe the VCs will be a little bit more lenient with valuation in order to get that deal done. Okay? There's no recipe for this. What we are going to see is all these kinds of gut decisions, many times cloaked as strategic reasons, right? But essentially this is fear, uncertainty, and doubt and greed that actually drives this, right? So if I don't make an investment in the first 6 months, what are my LPs going to say? Did we make the wrong bet? We're not even investing. Other VCs have announced these other investments. What are you? Are startups not coming to you? So on and so forth. Deployment status. By the second year, your fund has deployed only 10% of the fund. Now you're really shooting bricks, because now you need to show even more. How are we going to even justify our 2% management fee? Forget the. So the fund is going to be more hungry to deploy the money. Valuation in some cases is going to take a little bit of a backseat, or you, the entrepreneur, is going to get a little bit benefit because of that. You want to study this new sector from investment viewpoint. The best way to do this is actually make a small investment into a company, see how it performs, take a board seat or an observer seat or whatever, and then, you know, in the guise of guiding them, you actually let them guide you. Okay? Will I be willing to pay a little bit better valuation in order to get this opportunity? You bet. You're close to the end of deployment and feel good about your current portfolio. Again, two things can happen. You can be more cocky and say, no, 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 no. Right? I'm going to be much more choosy now, and therefore you will actually bring down the valuation, or you will say, I have a little bit of sliver left. It is okay to take this risk. I feel better about my portfolio before. And again, these are not the things that I'm just coming up with from my brain. These are actual conversations that I have witnessed personally in each and every one of them, right, where these things were talked about. I'll explain what we do or what we can do, if at all, anything with this. Portfolio need, your portfolio companies need this solution. One Series A that we did, this was the reason one big investor came, right? Because they suddenly saw, oh, all my portfolio companies need this solution, there's something in it, and I can probably build better synergies and, you know, better value for everybody as a result. And the valuation was actually almost bumped from our investment to the next round. Within 1 year, the valuation jumped by 5.6x. Right? I don't think the company deserved that valuation if you put kind of numbers together, but it was much more strategic reason to get into the company. Portfolio coverage, you have complementary portfolio companies. I think you get the picture. I'm going to just go a little bit faster. Corporate constraints, which is an extremely funny situation that I have personally been in. Big corporate VCs, big corporate in the networking equipment space. They wanted to invest in this company, already did the negotiation, agreed on a particular valuation. Their mandate, as all corporates, big companies have funny ways of doing things, that you cannot invest yourself. You have to get another investor. So they came to us and said, do you want to invest? We said, yes, but not at this valuation. It doesn't, we don't agree with it. So we are going to talk to the company, see if we can bring down the valuation. The company knew that the corporate money would not come unless we came. And so we negotiated actually a much lower valuation, which we felt was appropriate. The deal fell through. The reason is that the corporate VC actually insisted on a higher valuation. Why? Because the company needed whatever money they needed, so that much money had to be invested for running the business or growing the business. That meant the corporate VC would have actually taken a higher stake if the valuation was lower. And that was going beyond the mandate or allowed mandate that the company could do from, you know, reporting and, you know, consolidation and so on and so forth viewpoint. Therefore, the valuation was much higher than what it was supposed to be. We walked out, they got another investor, and the company got the valuation. Right? Annual appraisal. This is where, you know, it's more of a emotion. People will talk about strategic reasons and give you a bunch of those, but it is really emotions. My partners have done great deals this year. I haven't done any. Right? I'm probably going to be more hungry in order to get the deal done, even at a higher valuation. This is true for us currently. We are raising new fund, and we would love to actually get one or two deals quickly done together so that we can start window dressing our fund, saying that, you know, these are the kind of deals that we are going to look at. We talked about corporate VC, etc. What is the use of all this? Can you control any of this? No, you cannot. But being aware that this happens actually can give you tremendous advantages when you negotiate, right? What that means is, don't just Go to the VCs because they have big name or whatnot. Understand your VCs. Ask questions. Who's the one who's leading the deal? What kind of deals have they done? What is their current status? What is their fund? Which fund this money is coming from? How many have they invested in? All these questions are extremely important and legitimate questions to ask. You should ask those questions to really understand who your VC is, right? And that can probably start giving you clues as to how they are going to look at valuation and how hungry they are going to be. Just a few things, bridging the gap. Finally, you and the VC still don't agree on valuation, but both parties want to do the deal. There's something called floating valuation, which means the valuation is decided based on some future milestones. Avoid that. Recipe for disaster, a lot of discomfort. There's also liquidation preference. I'm not gonna. This is a very insidious way of getting what you want. Having the cake and eating it too. So if it fails, all the risk is yours. Even though I have invested the money and I have taken equity stake. If it succeeds, then I get all the glory and 10x returns and all of that. But if it fails, you need to pay me still this much, in spite of what happens to the company. That is what liquidation preference is, and it can be really nasty. Avoid that. That is not the right investment. Okay? Don't be so desperate to just sign your life literally on a piece of paper. What do you do with this? I think the best thing that I can say to this audience, which is mostly first timers, is try to address this first timer bias or bias against the first timer, right? There's a very solid keyword is operational, financial. When I say financial, I'm not talking about go to the nitty gritty, hire a CA and a business analyst and spend a bunch of money with that. This is something that high school math, addition, subtractions, etc., will be able to tell you. But the keyword is operational. Why operational? What does the second timer know that you don't? Because they have been through that before. They have made mistakes, they have lived through mistakes, corrected those mistakes, simple mistakes. What does it take to hire people? How long does it take to hire people? When does a salesperson really become productive? All of those things, right? So think about those and build an operational cash flow model, right? Understand your risk, as I said. Bring them out yourself in front of the VC. And then talk about how you would address them, how you would mitigate them, how you would prevent them, all of that. Your assumptions need to be extremely sound. Explain what they are, explain why they are so, explain the triangulation that you have done, who you have talked to, in how many different ways you have thought about this and formed your assumption, because we are going to do that. This is something that I think, just 2 minutes. Is very important. Just understanding your ecosystem starts with what Vishwas was saying, but it's mind-boggling how many entrepreneurs actually just don't do that. In spite of all sorts of sessions and workshops, and they still don't. And if they do it very superficially. Right? And know your VC, as I said. Last one, very important. Most of the times we get in terms of, oh, my venture is going to have this kind of PE and this kind of price to sales and so on and so forth. Operational execution is more important. You're a first timer. I have already a bias against you. If you talk in terms of these kinds of ratios, how is my market going to be segmented? What is going to be my share? How much share can I get? Why I think I can get that share? What is going to be my sales efficiency? Why I think it is going to be that? So on and so forth. These are very operational kind of ratios and numbers which I am really looking for. And if I see that coming from you, they may be wrong in some cases. But just the fact that you're talking about those and you are aware of those tells me that you are aware of the execution challenges. And then last one is be open to serendipity. Because as I said, serendipity, everybody knows, it's kind of a chance discovery. But kind of pleasant one, okay? Because, as we said, there is a whole bunch of knowledge. Theoretical knowledge, statistical knowledge, empirical knowledge, all of that. But nobody really has a clue when it comes to a specific investment. What should we do? There are no clues. Now you know as much as VCs do about valuation and about negotiation. So welcome to the club.
Thank you so much, Anil. What we'll do is we'll quickly get into another session, and we will have the discussion leaders to be on the podium, and we'll have 15 minutes for a Q&A. We are running short of time, so